All right, we're good to go now. It is still 6 o'clock. Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting. We can get rolling. So we'll call this meeting to order. We have a roll call.
You looking at me, Mike?
I'm looking at you. Yeah, might as well. It's easier for you to do it from there.
All right. So
you guys are on a small screen.
That's all right. We'll do OPEB first. Chairman Mike Vitello.
Here.
A week.
He was thinking about it.
Ron Badowski, Finance Director.
I am here.
I am here. First Selectman Kellogg is here. Town Council Representative Formicella
Here.
And the Vice Chair, Mr. Mandros.
I am here.
All right.
Hey, everybody. You've got Jason Maurer on the line.
All right. Going to the Pension Committee, Chairman Mandros.
I am here.
Board of Ed Representative Condon.
Here.
I am here. First Selectman Kellogg. Town Council Member Maurer has already announced his presence. Town Council Representative Formicella.
Here.
Vice Chairman Kirsch here. We have a vacant Board of Ed seat. Superintendent Kabza
Here.
And Treasurer Mr. Duchess here. I think that is it. And also present is Ms. Mead virtually. I think it's back to you guys.
Excellent. All right, we have the review of the minutes. We'll do the Pension Committee first. So can we have a motion to approve the voting minutes?
Okay.
Can we get a motion to approve the minutes for the Pension Committee?
Jason Maurer, so moved.
Do we have a second?
Steve Kirsch, second.
Any discussion? Hearing none. Any opposed? Hearing none, we pass unanimously. Now on the OPEB Board of Trustees.
I'll make a motion to approve the minutes of April 29th.
I'll second that.
Thank you, Ron. Any discussion? Hearing none. Any opposed? We are unanimous. All right, we're new business. We're gonna turn it over to Devin.
Okay, hello everyone. Can you hear me okay?
We got you.
Yeah.
Okay, great. Just one thing before we start going through the third quarter report. I noticed that item 4 on the agenda is International Equity Fund Replacement Recommendation. That was actually left over from the last time we met in April. So that is not an item that we will need to cover today. So I don't know if you need to formally make a motion to amend the agenda.
No, we just, Chair can just recognize that it's
exactly, we'll skip it over.
Okay, perfect.
Unnecessary Scribner's error and ignore it.
Okay, great. So does someone in the room perhaps have the ability to make?
I do have, we have the power, we have the technology.
Excellent.
Let's see, Devin. We are going to make you co-host. Co-host.
All right, it looks like I now have the ability to share my screen.
Beautiful. I'm going to try and change this. So, oh, there you go. Never mind. I don't need to.
Okay, so you can see that all clearly in the room, and then Mike and Jason and Heidi on the phone, you can see it all right?
Yeah, I have it on my big screen because Heidi shared it with me.
Good.
Because no, I can't see it on my phone.
Okay. Yeah, it's a little too small, I guess. All right, so I have the great pleasure of speaking to you about markets in 2022, which is not a wonderful topic. Certainly has not been good news thus far. Well, actually, I wish that we saved this till the end, but we'll talk about the pension landscape update first. This actually is good news, because if you look at your funded status, according to the most recent valuation, which was done on July 1st, 2021, compared to the previous year, there was a vast improvement in funded status, and both the town plan as well as the Board of Ed plan are now more than 100% funded. I am certain that that will not be the case when the 2022 valuation is conducted, but we might as well celebrate these milestones when we can. So you can see the vast improvement in funded status through over the course of that 1 year, and that was really a result of asset returns. So this was a very strong market year, so you saw a vast improvement in the funded status. The OPEB plan also saw an improvement in the funded status because contributions have been made. So of course, this is a much lower funded status, which is pretty typical for OPEB plans. So that status improved from about 35% in 2018 and moved up to about 44% in 2020. And you won't have the next valuation will be done as of 2022. I think you get that done.
Are those dates correct?
Yes. Yep, so that we don't have the results of the most recent one. I'm sure that Hooker and Holcomb is probably in the process of doing it. It typically doesn't get done until at least year end, perhaps early 2023, but it'll be as of 7/1/2022 when it's available.
That is correct.
Yep.
Thank you.
Great. And then something else that I just wanted to point out is that both the town pension plan and the Board of Ed plan are using an actuarial return assumption of 6.75%, and the OPEB plan uses a return assumption of 6.5%. So just to give you some context of where you stack up in relation to other municipal plans across the state, here on page 10, we show that the average investment return assumption across municipal plans in Connecticut was 6.53%. So just slightly lower compared to the town of Monroe's 6.75, but the median was 6.75. So you're right in line with the median and a little bit higher than the average. There has been a trend, which we've discussed from time to time, of municipal plans lowering their investment return assumptions. That's been something that we've discussed at the committee level. Your asset allocation profile does need to justify the return assumption that you are using. So that's an exercise that we go through with Hooker and Holcomb every year, where we provide our capital market return expectations and we show the asset allocation profile of the portfolio. So we do think that 6.75% is achievable and justifiable. But you know, over time, the trend has been for plans to move downward, and you know, we certainly we're open to that discussion, and that's a discussion that you should have with the folks at Hooker and Holcomb as well. One thing is that we might expect, in terms of trends, we might expect the downward trend of return assumptions to pause, maybe not move any lower. And that's because of a couple different factors. One is that bond yields are much higher now than they were a year ago. So whereas the portion of the portfolio that's exposed to fixed income, you know, over the past several years, we haven't expected robust returns from fixed income. Now that interest rates are much higher, return expectations for fixed income are higher. So therefore, it's easier to justify a return assumption that, you know, may be a little bit higher. So it's not quite as necessary to bring that assumption down. And the very adverse market conditions that we've seen so far this year have meant a very big sell-off in equities, which, believe it or not, actually brings forward-looking return assumptions for equity markets up. So because of those two factors, it's possible that we may see that the downward trend in return expectations kind of comes to a stall. We might see return assumptions kind of level off about where they are right now. On page 11, we can see funded ratios for Connecticut municipal plans, and there was a vast improvement for most plans when you compare 2020 to 2021. Obviously, you saw that big improvement for both of your pension plans. And what's great is that the town of Monroe is better funded than most plans in the state of Connecticut, and that's something that we've talked about over the years. So the average funded status as of fiscal year 2021 was at just below 86%, compared to about 72% the prior year. And remember that you were at 107% for the employees plan and about 103% or so for the Board of Ed plan. So you're certainly above and beyond your peer group. So you would fall here in this category, which shows plans that are between 100 and 110% funded. And then in terms of OPEB funded status, the average funded status reported as of 2021 was 43.1%. You'll remember that you were at 43.9, so right in line with peers. And the average investment return assumption was 6.5%, which is exactly where you are. So you can see when it comes to OPEB plans, the vast majority of them are not particularly well funded. You see the majority of them being somewhere below 60% funded. So right here in this 40 to 60% bucket, that's where your plan lies. So certainly you're keeping up with peers. So I'll take my screen down and pause for a moment, ask if there are any questions about the governance calendar.
When do we expect to get the report from Hooker and Holcomb? The Ron question.
Yeah, Ron, I'm not sure if you have a better idea. I don't think it ever happens before year end. I think usually
You're talking about the OPEB report or the pension valuation?
Either one. Or both.
Well,
Probably trying to get to the ADEC.
yeah, so I would expect that closer to year end, Mike.
Okay,
Probably
that's what I
December
figured, but I just figured for the
timeframe.
record for everybody. Yeah.
Yeah.
All right. So let's jump right into the capital markets review, as depressing as it may be. So it's been really, as everyone I'm sure is well aware, a terrible market environment. We've had very high inflation, which is having an impact on both consumers and corporations. Because of that very high inflation, we've had a very aggressive Fed rate hike campaign, the fastest rate hike campaign in history. And we also have the added complexity of a war in Eastern Europe. So it's been kind of a perfect storm of adverse market conditions. The fact that the Fed has been embarking on this rate hike campaign in order to tamp down inflation means that, that we have rising interest rates. And you'll remember this is something that we've discussed before, but interest rates and bond prices have an inverse relationship. So when interest rates are rising, that means that bond prices are falling. So it's been a really difficult market environment, not only for equities, but also for fixed income because of the rising interest rate environment. The silver lining in this is that now bond yields have a positive real yield looking forward, which has not been the case in many years. So because interest rates were so low prior to this Fed rate hike cycle, when you strip away inflation, real yields were actually negative. So you were losing purchasing power by being invested in bonds. Now that we have a much higher yield profile across the yield curve, you're actually looking at positive real returns from bonds when you strip away long-term inflation expectations. So that's the silver lining. So there's a lot of pain in getting from point A to point B. Point A being a very low interest rate environment and point B being a more normal interest rate environment. There's pain making that move, but once you're at point B, that's better for fixed income investors in the long run. In terms of Mike, I thought you might be raising your hand for us, but.
No, just saying goodbye to a couple people.
Yeah.
Surrendering.
So a lot of the talk and headlines seem to be focused on whether we are in a recession, whether we're entering a recession. If we do enter into a recession, is it going to be really long and painful, or is it likely to be shorter and a bit more modest? All signs do point to the fact that recession is probably on the horizon. We did have 2 consecutive quarters of negative GDP growth, although we just got the GDP number today and it was positive. Although that number did show that consumers are spending less, and consumers are, kind of what drives the economy. So that's a bit concerning, but it was a positive print today. But in addition to those 2 quarters of negative GDP growth, which we saw, we also have an inverted yield curve. And what that means is that, I think we have this, yep, you can see it here on the top left-hand side of page 17. That means that yields on the front end of the yield curve, shorter dated treasuries, have a higher yield than longer dated treasuries. So right now, the 10-year yield is at about 4%, whereas a 2-year is at about 4.3%. So typically the yield curve is positively sloped. That's kind of a normal environment. And the reason that I call your attention to this is that an inverted yield curve has historically, been the predecessor of a recession. So when we've had inverted yield curves, typically we have tended to end up in a recessionary environment. Not necessarily every time, but it can be a harbinger of recession. The good news is that it doesn't really matter from an investment perspective whether we enter a recession or not. So remember that we invest in markets, we don't invest in the economy. And markets and economies do not follow the same path. So they are not, coincidental. And so just to give you a couple of data points, typically markets are leading indicators and then the economy is kind of lagging. So markets tend to peak about 7 months before the economy peaks. And then markets tend to bottom about 4 months before the economy bottoms. And furthermore, the National Bureau of Economic Research is the governing body that formally announces whether or not we're in a recession. They have always been very slow to make that announcement because it's based on backward-looking data. So historically, the NBER has announced the start of a recession 7 months after the recession actually starts, and then they've announced the end of it about 15 months after it actually ends. So markets tend to peak and bottom before economies do. And then we tend to get this report of, oh yeah, we're in a recession much later. So typically by the time you get that formal announcement, the market has already started to climb its way from the bottom and has started to rebound. That's been what the pattern has been historically. So I'm not necessarily saying that will definitely be the pattern this time, but that basically is what we are expecting. So I know I've gone through a lot of things. I'm certainly happy to go through the other slides in the capital markets review, but I thought I'd pause and ask if there are any questions or anything you want me to cover specifically. Okay. And I mentioned the silver lining about bond prices. I guess I would be remiss to not mention the silver lining of equity valuations as well. So certainly valuations do look less expensive across the board, not only here in the US, but also in international developed and emerging markets. So this little green bubble represents valuations as of the end of the third quarter. So in the US, we were below median, and then international developed and emerging markets were basically one standard deviation cheaper relative to history. So that would suggest that perhaps there's a bit of upside potential. So we try to look on the bright side. All right, so if we move ahead in the report, I'm looking at page 25. There has not been any significant portfolio activity over the course of the last quarter. When we last met in April, because we missed our July meeting, The decision was made to terminate Lazard International Equity and replace that with the Dodge and Cox Fund. So that those trades did go through in the second quarter, and then nothing of significance happened in the third quarter. So page 26 just shows a brief snapshot. This is for the town pension plan, and the results for the Board of Ed pension plan look almost exactly the same. So you can see for the third quarter, the portfolio was down 6.1%, whereas the benchmark was down 6.4%. So a slight amount of relative outperformance, but certainly nothing to celebrate in terms of absolute returns. And so far this year, on a calendar year-to-date basis, the portfolio is down 22.2%, right about in line with the benchmark. So again, it's been a terrible market environment. There's been nowhere to hide. Everything, you know what, I'm actually going to go back to this page. This shows the magnitude of asset class results, that the downside magnitude that we've experienced so far this year. So there's only one area of the market that has achieved positive results so far this year, and that's commodities, which is largely driven by energy. Everything else, even hedge funds, has been negative. So here, these navy blue bars represent fixed income. And again, we've had a rising interest rate environment, so that has meant falling bond prices. So the US core bond index, which is the Barclays aggregate index, down 14.6% so far this year. So those are bonds. Those are what's supposed to provide a safety net. But when you have interest rates jump by 300 basis points over the course of 6 months, that has an adverse impact on fixed income markets. And then equity markets have also struggled. You see double-digit negative returns for both US large cap and small cap, as well as international developed and emerging markets. One thing that is kind of an interesting point is that if you look at international equity returns in local currency, they actually held up much better than US stocks. So they were still negative, but they were negative in the mid-teens. But then when you translate that to dollars, because the dollar has been so strong, international markets have actually underperformed US markets. But you're looking at losses of between 25 and 30% across the equity universe. REITs have struggled, real assets have struggled, hedge funds have provided a bit of protection, but even they are down in absolute returns. So this has been a really unusual market environment, and that there's been nowhere for investors to hide. We don't think that will remain the case forever, but it certainly has been the case so far this year. So again, if we bring it back to page 26, dismal results on a year-to-date basis. On a one-year basis, the portfolio is down 18.8%. The benchmark is down 19%. And the poor performance over the past year, really the first 9 months of this year, has also had an impact on the longer term results. So if you look since inception, going back to midway through 2015, so just over 7 years, the annualized return of the portfolio was only 3.6%. To give you a point of reference, I'm looking at page 29, and this shows the calendar year returns. So we only had a partial year in 2015. 2016, the portfolio returned 7%. Okay, that's pretty good, right in line with the return assumption. 2017, it returned almost 17%. 2018 was a negative year, down almost 7%. 2019 up 20.4%, and then 2020 up 11.3, 2021 up 12.8. So despite the fact that you have managed to exceed your return assumption in 4 of the last calendar years, meet it in 1 and only underperform it in 2018 and then so far in 2022, you see the impact that the recent weak performance has had on these since inception results. But to that point, you also can see how it can so quickly turn around. So in the first quarter of 2020, when we had the market sell-off due to COVID, you saw portfolios decline by about 20 percentage points in the first quarter, and then they ended the year with a really strong result, up over 11%. So things can shift very quickly in the markets, but certainly the 2022 results so far have had a negative impact on the longer term returns of the plan. So if we go back to this snapshot page, I'm looking at page 26, you can see the allocation relative to your targets here in the bar chart on the right-hand side. Because we do raise cash for pension payments on a quarterly basis, you're usually right about in line with the target allocation. We'll use those cash raise opportunities as a way to kind of organically rebalance back to target. So we'll sell the areas of the portfolio that are overweight, and then we will not sell from the areas that are a bit underweight. So you can see that we've got a 25% target to fixed income, 39% target to domestic equity, 28.5% target to international equity, and then 7.5% to real assets. So if we look at page 28, this has all of the underlying strategies in the portfolio. We don't have any recommendations for changes right now, but the PGIM Global Total Return Fund has been placed on watch status. So I'll just take down the screen for a moment there. So that is a global bond strategy. I believe that we've talked about it over the last couple of quarters. Their performance has been very weak relative to their benchmark, but more importantly, they just recently updated their team structure, where they brought in the co-CIO of PGIM to serve as a portfolio manager. And this new person, he's not new to the firm, but he's new to the investment team. He has veto power, and it seems that they're kind of bringing him in an effort to right the ship, but they might be scrambling a bit. And we have some concerns about the way that their portfolio managers are compensated based on a 3-year performance number. And so we expect that because of this team change and because of the comp structure, there might be some attrition from the firm. So that's something that we're keeping a close eye on. And my expectation is that at the next meeting, we will have a recommendation for a replacement manager within that segment of the portfolio. Other than that, all of the other managers are on maintain status. We don't have any particular concerns. If we look, let me bring the screen back up and I'll briefly talk about underlying asset class performance. If we look here at page 30, we show the fixed income composite results. So on a year-to-date, this is calendar year-to-date basis, your fixed income managers collectively are down about 13.6%, which is not good in absolute returns. But when you look at it compared to the benchmark, which is down 17%, your managers have helped provide some protection. And that is exclusively a result of the BlackRock Strategic Income Opportunities Fund. So remember that we added that fund that has an unconstrained fixed income mandate. So with very low interest rates and the expectation of a rising interest rate environment, BlackRock has the ability to have a much shorter duration profile, and their risk profile is diversified away from pure interest rate risk, which is what you see in most fixed income instruments. So having that exposure has been really helpful. They've lost only about half of what the aggregate index has lost so far this year. So that's the driver of outperformance for the fixed income segment of the portfolio. If we look at the domestic equity segment, it has lagged a bit compared to the benchmark. So it's down 24.6% year to date compared to 23.9% for the benchmark. The kind of Bellwether strategy within the domestic equity segment of the portfolio is the 500 index fund. It's going to match the performance of the S&P, so no surprises there. But then we have active management on the small and mid-cap side. We've got Diamond Hill representing the value side and Conestoga on the growth side. And Conestoga has underperformed its benchmark so far this year. That is a pretty concentrated strategy, only about 25 to 30 holdings. So they are prone to periods of volatility relative to the benchmark. That's not a strategy that we are particularly concerned about. So despite the underperformance, we have no recommendation to get out of Conestoga. We're comfortable with their process and nothing has changed from a team perspective. And then year to date on the international managers, you see that they too are behind the benchmark. Remember that we did replace Lazard, which had substantially underperformed. So that's part of the lag that you see on a year to date basis. Dodge & Cox did replace Lazard. So even though they were only in the portfolio for one full quarter, they did outperform Lazard for that quarter. And then we have MFS, which has a little bit of a growth bias, whereas Dodge & Cox has a value bias. And Harding Loevner on the emerging market side has been a significant driver of the relative underperformance in the international equity segment. So you'll remember, or you may not, I'll remind you, that we talked about Harding Loevner a couple quarters ago, and they had underperformed pretty substantially for two reasons. One is that they had a fair amount of exposure to Russia coming into 2022. The invasion of Ukraine was not their base case scenario, so they did have that exposure, which essentially was marched down to zero. And their Russian exposure was the only exposure that they had in the portfolio to commodities. So commodities, if you'll remember back at that bar chart that showed all the asset class returns, commodities are the only area of the portfolio that has produced positive performance so far this year. So the fact that all of their commodity exposure went away because it was marked down to zero, that is what has driven the Harding Loevner underperformance. They did actually outperform in this quarter. So when we talked about them the last time, I asked if the committee was willing to be patient. This is still a strategy that our investment team has conviction in, and it's something that they like. And they did provide a little bit of relative outperformance in this quarter. So again, that's not something, despite the weaker numbers, that's not something that we're recommending shifting away from. And then finally, the last piece of the portfolio, and then I will curb my comments, is the Principal Diversified Real Asset Fund. So you'll remember that provides exposure across the real asset marketplace. So it has exposure to REITs, commodities, natural resource equities, infrastructure, and TIPS. So that has provided a bit of an inflation hedge. Not great performance by any stretch of the imagination, but that piece of the portfolio has held up a bit better than broad fixed income and equities. So before we move on to the OPEB, can I answer any questions or address any concerns about the pension plans? Okay.
Good.
Great. And I'll be quick because the pension plan is much more straightforward. There's no active management in there. So on page 53, we just show a quick recap. There was a contribution that was made at late in the fiscal year. So we did put that money to work. And we did that according to a dollar cost averaging strategy. So we did it about every 6 weeks, investing a quarter of that contribution. So we have done 3 of the 4 stages of the dollar cost averaging, and we're set to do the final stage in mid-November. This type of market environment is exactly why we do dollar cost averaging, because we've seen the market consistently go down, and that means that we didn't invest all of that contribution at one time and then have the entire asset pool ride the wave down. So we've been able to put the funds to work at lower valuations essentially throughout this dollar cost averaging strategy. So on page 54, we can see the performance. Of course, as you would expect, it's always been right in line with the benchmark. On a calendar year-to-date basis, this portfolio is down 22.3%, down 19.1% on a 1 year. You know, again, we have this asset allocation profile where it's exposed to all areas of the market, all of which performed poorly. So again, no place to hide there. But if we look at the manager strategies on page 56, as I mentioned, this OPEB portfolio, because it is such a small asset pool, we simply have index exposure. So it's all Vanguard index funds that will track the performance of their specific benchmarks. And the asset allocation structure aligns pretty closely with the pension plans, a bit more in fixed income, a bit less in equities, which is simply a reflection of the fact that it has a slightly lower return assumption. So again, despite the negative results and despite the challenging market environment, we don't have any recommendations to make any portfolio changes. We think that the asset allocation profile is appropriate for the long term. We think that your return assumptions are justifiable, and with the exception of probably recommending a replacement strategy for PGIM next quarter, we don't have any other proposed investment changes on the horizon. Any questions? Anything I can dive into a bit deeper?
No.
It looks like everyone in the
I'm
room
good.
is still awake, so
Yeah,
I'm
exactly. We didn't
surprised
pass out
and
yet.
happy to see that. That's it from me.
All right. Anybody, nobody else has any questions? I'm actually pretty good. It was actually less painful than I thought it might be.
Keep the bar very low, right?
Exactly. Keep the bar very low. All right. Well, since we took off number 4 off the agenda, it looks like we're pretty much wrapped up unless anybody else has any other questions. I guess we got to wait till we get the new evaluations and see, you know, how much below 100 we are again. But we did, for the first time in all the years I've been on it, break the 100. So we have a point in time, at least. That's something.
Yep.
Which was great to see. So, all right. Someone want to make a motion to adjourn? Let Devin get back.
Motion to adjourn?
I'll
Thank
second.
you, guys. Devin, again, thank you for a great job. We always appreciate this.
Thank
So,
you, everyone. Great
Even
to
in
see
bad
you.
times, we like to see you. Thank you.
Oh, good. I like to see you as well. Thanks, everyone. Bye-bye.